Debt consolidation sounds simple. Combine everything you owe into one payment, and life gets easier. That promise is exactly why so many people jump at it without checking one thing first, and that one missing check is where a lot of people end up worse off, not better. This video is not here to tell you debt consolidation is good or bad. It is here to show you what it actually is, so you can tell the difference between a smart move and an expensive mistake. Quick disclaimer before we start. This video is for general educational purposes only and is not financial or legal advice. Loan terms, programs, and eligibility rules change over time, so always confirm current details directly with your lender or a licensed financial professional before making any decision about your own debt. Let's start with what debt consolidation actually means, because the word gets used loosely. At its core, consolidation means combining multiple debts into a single new payment. That's it. It does not automatically mean a lower interest rate. It does not automatically mean less total debt. It just means fewer things to track. Whether it also saves you money depends entirely on which method you use and what terms you're offered. There are three main paths people take, and they work very differently from each other. The first path is a personal consolidation loan. You borrow a lump sum from a bank, credit union, or online lender, and use it to pay off your existing debts, usually credit cards or other high-interest balances. You're left with one loan, one fixed payment, and ideally a lower interest rate than what you were paying across your old debts combined. The second path is a balance transfer, which applies specifically to credit card debt. You move balances from one or more high-interest cards onto a new card, often one offering a promotional 0% or low interest rate for a limited time. This can save real money, but only within that promotional window. Once it ends, the remaining balance often jumps to a much higher standard rate. The third path is a debt management plan, usually set up through a non-profit credit counseling agency. The agency negotiates with your creditors on your behalf, sometimes securing lower interest rates, and you make one monthly payment to the agency, which then distributes it to your creditors. This path doesn't involve a new loan at all, and it typically closes your existing credit accounts as part of the arrangement. There's a fourth path worth knowing about too, though it comes with more risk attached. Homeowners sometimes consolidate debt using a home equity loan or a home equity line of credit, borrowing against the value of their house to pay off higher interest unsecured debt like credit cards. The appeal is a lower interest rate than an unsecured personal loan can offer, since the loan is backed by your home. The real risk is exactly that backing. Unsecured credit card debt, if you default, damages your credit. A home equity loan, if you default, can put your actual house at risk. Trading unsecured debt for debt secured by your home is a meaningfully different risk profile, not just a different interest rate, and it deserves more caution than the other three paths. Here's the catch most people miss, and it's the same type of trap that shows up across almost every kind of debt, not just credit cards. Consolidating debt into a new loan or plan can affect protections, fees, and total cost in ways that aren't obvious from the marketing alone. A lower monthly payment can hide a longer repayment term that costs you more overall. A promotional 0% rate can hide a balance transfer fee charged up front. A debt management plan can require closing accounts that affect your credit history length. None of these are necessarily bad, but all of them need to be understood before you sign up, not after. Let's put a number on this, because it depends on the terms, can sound vague until you see it in dollars. Say you have $15,000 in credit card debt spread across 3 cards, each around 22% interest. A personal consolidation loan offers you a fixed rate of 12% over 5 years. On the surface, that's a clear win, a full 10 percentage points lower. Over the 5-year term, that rate difference alone can save you several $1,000s in interest compared to slowly paying down the original cards at 22%. Now picture a different offer for the same $15,000. A lender offers a rate of 12%, but stretches the term to 10 years instead of 5, to keep the advertised monthly payment low. The lower rate is real, but the longer term means you pay interest for twice as long. Depending on the exact numbers, that longer term can actually cost you more in total interest than the original higher rate would have over a shorter period. Same lower rate, same lump sum, but a completely different result, purely because of the term length attached to it. This is the core lesson with debt consolidation across every method. A lower rate or a lower monthly payment is only half the picture. The other half is the total repayment term, and that second half is where a lot of the real cost hides. Here's one more version of this same trap, specific to balance transfers, since the mechanics work a little differently there. Say you transfer $8,000 in credit card debt onto a card offering 0% interest for 18 months, with a 3% transfer fee charged up front. That fee alone costs you $240 immediately, before any interest even applies. If you pay off the full balance within those 18 months, you still come out ahead compared to sitting at a high standard credit card rate the whole time. But if 18 months pass and a few $1,000s are still sitting on that card, the rate jumps to whatever the card's standard rate is, often back up near 20% or higher, and the clock essentially resets on the high interest problem you were trying to solve in the first place. So how do you actually evaluate whether a consolidation offer is worth taking? Start by adding up your current total balance and your current weighted average interest rate across everything you owe. This is your baseline. Every offer you compare gets measured against this baseline, not against the offer's own advertised numbers. Before comparing any offers, it helps to gather everything in one place first. Pull your most recent statement for every card or loan you're considering folding into a consolidation, so you have the exact balance and rate for each one in front of you. Note the minimum payment on each, since that tells you your current monthly baseline too. Having all of this laid out side by side, rather than scattered across different banking apps, makes every comparison afterward much faster and much less error-prone. Next, for a personal loan offer, check 3 things. The interest rate, compared to your baseline. The repayment term length. And any origination fee charged up front, since that fee effectively increases your real cost even if the rate itself looks attractive. Multiply the monthly payment by the number of months in the term to see your true total repayment amount, and compare that total directly against what you pay sticking with your current debts at the current pace. For a balance transfer offer, check the promotional period length, the balance transfer fee, which is typically a percentage of the amount transferred, and critically, the standard interest rate that kicks in once the promotional period ends. A balance transfer only makes sense if you have a realistic plan to pay off the transferred balance before that promotional window closes, otherwise you risk landing on a high standard rate with less time left to pay it off. For a debt management plan, ask the credit counseling agency directly what interest rate reductions they can realistically negotiate with your specific creditors, what the monthly program fee is, and how the plan will affect your existing credit accounts and credit history. Non-profit agencies vary in effectiveness, so it's worth confirming accreditation, for example through the National Foundation for Credit Counseling, before committing to a specific agency. One trap specific to this pillar worth calling out directly. Some companies market themselves aggressively as debt consolidation specialists but are actually for-profit debt settlement companies operating under different branding. Settlement is a fundamentally different process, where a company negotiates to pay less than you owe, usually after you stop paying creditors for a period of time, which can severely damage your credit and carry tax consequences on the forgiven amount. If a company's pitch involves stopping payments to your creditors as part of the plan, that is settlement, not consolidation, regardless of what the advertising calls it. Another trap worth knowing. Consolidating debt does not fix the spending pattern that created the debt in the first place. If a personal loan pays off your credit cards but the cards themselves stay open and get used again, you can end up with the original debt back, plus a new loan payment stacked on top of it. If you consolidate, it's worth deciding in advance what happens to the old accounts, whether that's closing them, freezing them, or simply committing to not using them, so the underlying problem doesn't quietly rebuild itself. It's also worth knowing what consolidation does to your credit score in the short and medium term, since this surprises a lot of people. Applying for a new personal loan or a new balance transfer card triggers a hard credit inquiry, which can cause a small, temporary dip in your score. A debt management plan, since it typically involves closing existing accounts, can lower your average account age and your available credit, both of which factor into your score. In most cases, these effects are temporary, and the track record of consistent on-time payments on the new consolidated debt tends to rebuild and often improve your score over time. But if you have something credit-sensitive coming up soon, like a mortgage application, timing your consolidation around that matters. To summarize how to approach this. First, gather every statement and calculate your current total balance and weighted average rate as your baseline. Second, identify which of the 3 or 4 paths actually fits your situation: a personal loan, a balance transfer, a debt management plan, or home equity borrowing, since they solve different problems and carry different risks. Third, compare any offer's total repayment cost, not just its monthly payment or headline rate, against your baseline. Fourth, watch for settlement companies disguised as consolidation services. Fifth, have a plan for the old accounts so the debt doesn't quietly return. And sixth, consider the timing of the credit impact if you have another major credit application coming up soon. Debt consolidation can be a genuinely useful tool when the math actually supports it. The people who get burned by it are almost always the ones who looked at the monthly payment alone and never checked the total. If this helped clear up how consolidation actually works, you know what to do. And if you're running a small business carrying debt specifically, the numbers and the traps look different enough that they deserve their own breakdown, which is exactly what we're covering next.